Next one is Fair Credit Reporting Act. If you knew nothing about this law, you could probably guess that it has something to do with the credit reporting, right? The fairness of credit reporting, right? That's exactly what this law is all about. The Fair Credit Reporting Act is also known as Regulation V. Remember, you've got your V and you turn it to the side and it makes an F. The Fair Credit Reporting Act is exactly what it sounds like. It is, you have to report credit fairly under this law. So it's like if somebody's not late on their payment, but you reported them late, you have to fix it and correct it and make it show that they were on time, not late. Lots of different things or factors go into this, and we're going to talk about all of them. Now, this is supervised by the Federal Trade Commission, but again, it's overseen by the CFPB. It's enforced by FTC, but again, everything pretty much finance related does fall under the CFPB. This again deals with giving borrowers access to their credit information, giving debtors, the borrowers, the right to seek damages if something's not appropriately done. You can actually, if something's reported incorrectly, go back and fight with the reporting company that is showing the negative information and show them that it cost you getting a mortgage loan and you could actually receive some compensation for that. Responsibilities of creditors to protect against identity thieves. This is, again, a growing problem in our country, well, basically in the world, simply because we do so much on the cloud and on our computers and through the internet. It's just made more of our information at risk of being discovered or taken by others. All right, but that's what this law does. It gives us all of this new information about how to get access to our credit information. Also, again, what damages you can receive, and gives responsibilities to creditors as well. So your consumer credit right is to receive a free credit report, not score, a free credit report, if information on that report resulted in adverse action. Your loan was turned down, you were told it was because of a credit reason, you have a right to get your credit report so you can fix the reason or fix the problem, or at least learn about whatever the problem was so that you can hopefully fix it in the future. If you've been a victim of identity theft, you have the right to see if any other damages have been done. If any inaccurate information resulted from fraud. So somebody stole your information, or they stole your credit card number and they bought all these purchases online, you were damaged. So you have the right to know if any inaccurate information on your credit report was a result of a hacker or just some fraud perpetrator. All right, public assistance or unemployed. This one perplexes people. Why would me being on public assistance allow me to get a free credit report, or if I was unemployed? Number one, I don't know the last time anybody went to go look for a job. Credit is a huge factor. Very often, a credit report is taken into consideration when you're applying or being offered a new job. So if you're on unemployment, it begs to reason that you probably have limited income. So it shouldn't be expected that you're going to go and pay for a credit report so that you can see what's on it, that you can at least address whatever problems you may have had from a credit from a credit standpoint. So if you're on public assistance, you probably, again, are on low income. If you're unemployed, you probably have low, if no income. Therefore, these items, however, do influence your ability to get a job. So government says, we need to give you a credit report for free. All right, you also have the right to request a copy of your credit score, but it's not free. Although, in a mortgage loan transaction, you will get a disclosure that tells you what your credit scores are, but it's not a copy of the credit report. You need to contact one of the three bureaus, again, Experian, TransUnion, and Equifax, in order to get your free copy of your credit report. You're entitled to one a year from each agency. All right, you are, of course, allowed to dispute incomplete or inaccurate information, and you can also limit pre-screened offers. What the heck is a pre-screened offer? It's all that junk you get in your mailbox that is just, mail you're going to throw in the garbage and fill up all the landfills with. Hopefully you're putting it in a recycle bin, but hey, that's a whole nother story. Limiting pre-screened offers. You probably see a ton of junk mail come through that's an offer for this credit card or that credit card or this home loan or that refinance or this car loan or for this thing or that thing. It's all these little free offers for credit. Those are pre-screened offers. They didn't hit your credit score in order to have that information sent to you, but they are solicitors who are trying to get you to bite and get their credit card. So having said that, if you don't want to get those in the mail anymore, you can limit pre-screened offers by going to annualcreditreport.com or going to each of the 3 bureaus' websites as well. All right, agency obligations. What does that mean? Well, an agency obligation is somebody who reports credit information to the bureaus. They may not report outdated or negative information for more than 7 years, okay? So as a credit agency, they cannot report outdated negative information. Good information can stay on your credit report until the end of time. Good credit information. Bad or negative credit information, things like late payments, charge-offs, collections, bankruptcies, foreclosures, things like that, can only show up on your credit report for 7 years, unless you have a bankruptcy Chapter 7, and that can stay on your credit report for 10 years. All right, must limit access to a credit file. Typically, when it comes to a credit report, you are never supposed to give a copy of it to the borrower because that includes private information like social security numbers. If it were to get stolen, that's going to be on you because you gave them something you weren't supposed to give them in the first place. But also a lot of times appraisers or real estate agents or other organizations will ask you for a copy of the borrower's credit file. If there is not a financial need for that company or that person to obtain their credit, you should not pass that information along. There's a lot of argument. Should the real estate agent be able to ask for a copy of the borrower's credit report or know what their scores are? I am not exactly sure if they have the right to know that or not. They have the right to know whether or not their property has got a solid borrower, but if they've got an approval from a lender, what's your financial need to know whether or not this borrower has good credit? It doesn't matter what their credit is as long as they have an approval from the lender. So big picture point here is you have to limit the access to a credit file to someone with a legitimate business need. All right. You may not give out consumer credit information to an employer or a potential employer without customer consent. All right, so if somebody calls up and says, "Hey, I want pass off your credit, your customer's credit information to us," not without their consent, I will not. Anybody who's looked for a new job anytime within the last few years, you probably were required to sign a consent form that said, I'm allowing you to pull my credit for my potential employment or my current employer. So you have to give consent as a consumer before they are allowed to pull that information. And that leads us to the FACT Act. The FACT Act, I told you before, is a law that prevents against fraud, or it fights against fraud. So remember, if something's not factual information, it is fraud. So fact equals fraud. Everything in this law is all about preventing fraud. So the FACT Act stands for Fair and Accurate Credit Transactions Act. All right, that was created in 2003, and it provides for a free copy of the credit report once every year from each of the 3 bureaus. This law says you can put a fraud alert or a freeze on your credit. If somebody's in the military and they're going to be out to sea for 3 months, they don't want anybody to be able to obtain credit. Because sometimes what happens is you have what we call dumpster divers. They'll go into somebody's trash bin and see all these credit card offers. They notice that your mail's piling up, so they expect that you're gone away somewhere. Maybe you forgot to turn your mail off. They see these mailers about credit, and they fill it out and send it in under your name. Then they change the address later, because you're not home anyways. You're just going to go and grab it out of the mailbox. Federal offense, by the way, but be that as it may. So you know you're going to be out of town. You know you're going to be gone. You're going to be on deployment in the middle of the ocean somewhere. Well, you might want to put a credit freeze, which means that nobody will be able to obtain credit under your name, your social, or what have you during these dates that you are gone. Okay, now fraud alert. I've had to put several fraud alerts on my credit report because information was compromised. So once upon a time, my mail was stolen when I was on vacation. Somebody was supposed to be picking it up. They didn't. So my mailbox got overfull. Somebody noticed that I hadn't been picking up my mail and probably on vacation. They stole my mail out of my mailbox. And I got a call from the police department that said, hey, we just found somebody who was trying to cash a check in your name. They had ID, but something was fishy. Anyway, they found a whole bunch of my mail in their car. Having said that, I immediately was able to put a fraud alert on my credit report. And what that means, or what it allows you to do, is that when you apply for credit, you put a phone number down on the submission of the fraud alert that says you need to contact this phone number in the event somebody is trying to apply for credit. One of the kind of more recent things that has happened and is becoming more and more prominent over time, filing false tax returns. People are trying to get tax refunds, so they're filing these false or fraudulent tax returns under other people's names with a different address and taking the money and running. Well, if you know this has happened or you've been alerted that this has happened, you put a fraud alert on your credit report. From that point forward, for the next several months, if someone tries to apply for credit in your name, even if it's you applying for credit in your own name, you're going to get a phone call from that credit agency that says, hi, are you in Macy's right now applying for a credit card? And you're going to think it's kind of creepy and you have some weird stalker. Not the case. They're going to now have to ask you a series of personally identifying information questions, things that are very odd. Did you live at this address between the years of 1990 and 2010? So very background things that a lot of people wouldn't know about you other than you, unless they've known you very, very intricately for your entire life. Ask you questions about addresses that you were associated with, past businesses, past companies, past cities you've lived in, things along those lines, not your typical what's your mother's maiden name stuff. And what they're trying to do is verify that you truly are the person who is applying for the credit. The person who's applying for the credit is actually the person whose information is on the application. So that is what a fraud alert will do for you, and that is required under the FACT Act. Right, requires businesses to truncate credit card numbers on a receipt. Okay, prior to 2003, you would see an entire credit card number printed out on a receipt, okay? If anybody's my age, and I'm not gonna tell you what that is, but if anybody is my age or around about, you'll remember back in the day when an entire credit card number would show up on a receipt. Even the old swiper forms that had carbons in them, you have to tear that up or shred it because it has the entire credit card number on it. Well, since 2003, FACT Act says you gotta truncate that stuff. If somebody finds that receipt, somebody shouldn't have to worry about if a big windstorm comes up and blows the receipt out of your hand, that you're going to be, traumatized because somebody's going to pick it up. It has your signature, your name on it, and be able to steal your identity or create, bad credit debts. So that is why this was created. And that is why the FACT Act requires businesses to truncate a receipt with credit card down to the last 4 or 5 digits. All right, this requires measures to secure and dispose of sensitive credit information. Very interesting. Back in the day in the mortgage world, I could sit at my desk with 10 different files piled up on it, and I could leave them there all night long. We used to have what was called the waterfall files. It kind of has that stacked thing so you could see all the names and the tabs on it. Could leave it there all day, every day. Now, because of the FACT Act, you must lock and secure the drawer that your files are going in. If you get up to go to the restroom, you can't leave that file on your desk. You need to put it in a secure location, lock it, take the key with you, go to the restroom, come back and take it back out again. Can't just leave it on your desk anymore. Also, you can't just tear up a credit report and throw it into the garbage can. That's something that needs to go into a shred bin or be burnt or shredded. You can't just keep that information laying around. If somebody looked at a credit report, at a loan application, it has your name, your social, your address, your phone number. It has everything on it that would be needed for somebody to steal your information. So it's really valuable to make sure you always know these laws, secure and dispose of your consumers' information properly. All right, under the FACT Act, there's something called the red flag rules. This is section 114 of the FACT Act. Here's a way to kind of remember what section red flag rules falls under. All right, so the FACT Act, one of the important sections is section 114. That 4 kind of looks like a flag, doesn't it? Flag, okay? So if you remember, flag, red flag rules, section 114. So just again, another little visual tool to help you remember some of the fine details of what you're going to need to know to pass your exam. All right, financial institutions and creditors must implement a written identity theft prevention program. FACT Act does not give you the step-by-step what's the word I'm looking for? Theft prevention program that you have to have in place. They say, company, mortgage company, lender, whatever, you need to create and implement your own theft identity or theft prevention program. Okay, we're not going to tell you what you need to do, but you need to figure out a plan so that you're securing your people's information. Okay, so again, they don't tell you exactly what you need to do. They just say you need to have a plan in place, and it has to be in written format. All right, card issuers, so again, credit cards, have to assess the validity of a change of address request. Because if I just send in a change of address request and say I lost my credit card, send it here, I'm going to be able to do a whole lot of damage with that credit card, especially if it's not mine and I just stole it from somebody else's mailbox. The user of a credit report must reasonably verify the identity of the subject in case of an address discrepancy. So if you have, that's one of the reasons why a lot of companies now, when they take payments, verify the zip code. Because if you've changed the address, that zip code's not going to go through. So you want to make sure that if you are the user of a credit report and there's an address discrepancy, that you go back and start asking those personally identifying questions. Under the FACT Act, there's lots of different things that can be red flags. They're all pretty common sense, to be honest with you. It would be an alert or a notification. It would be the note on the credit report that says this person has been a victim of potential identity theft or credit fraud. Make sure that you are personally identifying this individual. All right, suspicious documents come in. Personally identifying information is incorrect or different. Unusual use of a credit account, like if somebody has a line of credit and they only use it like for tiny little small amounts, couple $100 here, couple $100 there, and all of a sudden a $10,000 purchase on a home equity line comes up. That's suspicious activity. So you'd want to make sure that you contacted the customer before allowing that contact or that purchase to go through. Let the borrower know, hey, are you in Home Depot buying this big old thing? Because a charge just came through that's very unusual. Okay, so that's a little unusual or suspicious. Anytime there's a notice from a customer, a victim of identity theft, even a law enforcement authority, or some other business with the possibility that identity theft has occurred in conjunction with a covered account, you need to act cautiously. You need to make sure that you are paying attention to that notice. I have had an example before where I said I was contacted by a police department that said, hey, your information's been compromised. I would have never known that somebody had my information had I not gotten that phone call. So again, when somebody gets a notice from the customer themselves or a law enforcement agency or anything else you see listed here, you have to pay attention to it and handle it just as if it was a report from the consumer. So our next law is Gramm-Leach-Bliley. Now you heard me mention a little bit earlier that Gramm-Leach-Bliley, they were 3 senators or congresspeople, and the way to remember this one is that senators or congresspeople are supposed to protect the interests of the people they represent, right? Well, same 3 characteristics fall under Gramm-Leach-Bliley. Protection. So the 3 main principal parts of Gramm-Leach-Bliley are SPF, and that's not even on my screen, so I'm just going to share it with you anyway. That means safeguards rule or the safeguards policy, pretexting, and the financial privacy rule. Now we're going to cover all of those in great detail here in just a minute. But what you also need to know about the Gramm-Leach-Bliley Act is that its official title is Financial Services Modernization Act of 1999. Okay, you will be asked on your exam, what is the formal or the more commonly known title of Gramm-Leach-Bliley, or they could ask you in reverse. The Financial Services Modernization Act of 1999 is better known as the Gramm-Leach-Bliley Act. This is a law that protects, again, privacy, to protect and regulate the disclosure of consumer information. A lot of this is, who can you share information with, how do you obtain your information, and are they from secure sources? So this gives enforcement authority to federal agencies and to states to regulate how you obtain information and what you do with it and who you share it with. This applies to financial institutions. So Gramm-Leach-Bliley only applies to financial institutions. But you'd be surprised at how many groups of companies fall under the category of financial institutions. Places like lending, brokering, servicing of any type of a consumer loan, transferring or safeguarding money. Ever hear of MoneyGram, or what's the name of that group? They send money, wire transfers, Western Union, that's the word I'm looking for. Preparing individual tax returns or CPAs. Financial advice or credit counseling, that's your companies like your credit counseling groups. Also, providing financial advice, so your financial advisors and things of those nature, or people of that nature. Providing residential real estate settlement services. Settlement services like your escrow companies, your lenders, your title companies, things like that. And collecting consumer debts. So how you collect that information and what you do with it is regulated under the Gramm-Leach-Bliley Act. Now, this is what I was saying a moment ago. Gramm-Leach-Bliley are senators. They protect the people. The three principal parts under Gramm-Leach-Bliley is also about protection, SPF. Like sun protection factor, right? That protects your skin. So remember, the people, or the senators, protect the people, and this rule that was started by senators is about SPF. Now, obviously it doesn't mean sun protection factor. It means safeguards, pre-texting, and the next one is financial privacy. So safeguards and pre-texting requires financial institutions to design, implement, and maintain safeguards to protect and control consumer information. Safeguards policy says they have to ensure security and confidentiality of consumer records, protect against threats or hazards. If you're a financial organization, guess what? You need to have firewalls and several layers of password protection. That's why a lot of times when you have company computers and you're going on Wi-Fi, you have an extra level of security you have to go to make sure, like your not antivirus, but those programs that limit how information is sent out onto the internet. So those are, again, because of the financial protections required under Gramm-Leach-Bliley. They also protect against unauthorized access that could harm or inconvenience consumers. Again, if you've had a hacker, did you have the proper firewalls in place? Did you have the proper password protection? Did you have the complicated passwords that are needed, again, to keep people's information safe? So that's what we're talking about when we talk about the safeguards policy. Pre-texting. Interesting word that most people don't know. Pre-texting is the thought you give to a text message before you actually type it. Now, of course, I'm kidding. That's not what pre-texting means. Pre-texting means when you are trying to obtain information through a false pretense. So think false pretenses means pre-texting. Quick example would be, you've talked to your borrower 100 times today. You don't want to bother them for one more thing that you should be able to figure out on your own. So let's say you've got all their whole loan file in front of you. You've got lots of information. But because of the timing of the transaction, you don't know if the borrower made their most recent mortgage payment or not, or if it's still due. And that's a piece of information you're going to need to know. So instead of calling and inconveniencing the borrower, what you do, call up the lender. You've got their loan number, you've got their name, you've got their social. As long as it's a male doing a male name or a girl doing a girl name, then you call up and you say, hi, this is Mary Jones. I just wanted to make sure you guys received my last payment. And they come back and go, okay, well, what's your loan number and what's the last 4 digits of your social? And hopefully they don't ask you your mother's maiden name because you probably won't know that. And they say, yeah, your last payment was received on, May 15th, 2000, whatever year it is. And yeah, we received that payment and it's been applied. What you just did in that example was pretexting. You tried to obtain information, or you were successful in obtaining your information through a false pretense, pretending that you were the consumer. So that's what pretexting means, and you're not ever supposed to do that. All right, and then the last piece is financial privacy rule. This is what governs the collection of non-public personal information. What does that mean, non-public personal information? Really, it's anything that's information that could not be obtained through public records, okay? Address, available on public records, so that one's fine. Phone numbers are generally, and again, not public information, or I'm sorry, it's not public information. What else? But things like credit scores, credit reports, social security number, driver's license, passport numbers, not public information. Right? So anytime you're dealing with information that's not readily available, again, at public records, then you have to be very careful about what you're doing and how you're collecting it and who you share it with. So information that you obtain from an application, address, fine, that's available by public record. The social security number isn't. So that social security number would be considered non-public personal information. Credit bureau, credit scores, not public information. That doesn't show up on a title report. You have to specifically request a credit report in order to get a credit score or their credit information, not public information. And other transactions such as balances or purchase history, that is not public information. So you have to be very careful on how you gather it and who you share it with. This restricts when information may be disclosed to affiliated or non-affiliated third parties. Now, nobody ever really reads these disclosures, but these are the packets of information that you get mainly from banks or any other financial service provider, credit cards, things like that. You always get a little privacy notice in the mail that says, this is how we gather information, this is who we share this information with, and by the way, we're Bank of America, but we have 300 subsidiaries that are affiliates of Bank of America, so we can share your information with any of our affiliates, but we'll only share your name and phone number with a non-affiliate company. So that's what we mean by restricting who the information goes to. All right, this law, Gramm-Leach-Bliley, requires a consumer privacy notice to be given. But how often you have to give this privacy notice depends on the relationship between financial institution and consumer. And it provides an opt-out opportunity, or you have to provide an opt-out opportunity. Now, Gramm-Leach-Bliley distinguishes the difference between a consumer and a customer. A consumer is somebody who obtains or has obtained a financial product or service. These folks only have to get the consumer privacy notice before their information is disclosed to a non-affiliated third party. But what's the difference between a consumer and a customer? A customer is somebody with a continuing financial relationship. If I go to Western Union and I want to do a wire transfer, one-time transaction. So they would have to give their privacy notice before they shared my information with any non-affiliated third party. However, if it's a customer, and that would be something like a credit card relationship. If I have a credit card with American Express, that is a continued financial relationship until I or they terminate it. It's a continuing, ongoing process, not a one-time deal. In that case, you have to give, you have to give the consumer privacy notice every year during that financial relationship. So it falls under mortgages or anything that is a continued financial relationship, bank accounts, checking accounts, even financial accounts like IRAs, 401ks, mutual funds, stocks, bonds. If you have an investment account with Charles Schwab, you've got that financial relationship that is continuing, not a one-time deal. Therefore, they would have to give you their privacy notice once a year. If I was making, again, a one-time wire transfer, that's a consumer, because I just have one product, one time. That would make it a consumer versus a customer. All right, that's the highlights of Gramm-Leach-Bliley. Once again, lots more details on this, so make sure you refer back to your 20-hour materials. If you've already taken a course, you should have gotten materials with it. If you haven't, sign up for one right away. U.S. Patriot Act. Most people do not realize the U.S. Patriot Act is actually, U.S. Patriot is an acronym. Each one of those letters stand for something. Like I said, most people don't realize that. It stands for Uniting and Strengthening America by Providing Appropriate Tools Required to Intercept and Obstruct Terrorism Act. Quite the mouthful, right? So it's so much easier to just say Patriot. The main purposes of the Patriot Act is to detect and deter for money laundering or to detect anti-terrorism or money laundering activities. Actually, to detect terrorism or money laundering activities. So basically what they're going to do is ask for 4 key pieces of information so that they can compare that information with the FBI database or the CIA database that tells us whether or not there's any connection with a money laundering organization or with any terrorist group. That's the whole point of the U.S. Patriot Act. Now, the 4 pieces of information are known as CIPs, Consumer Identification Programs. Now, a lot of people go, how am I going to remember yet again another item that has all these things that are required under the U.S. Patriot Act? Here's a little trick for you. I think terrorists are cowards. They always do things behind hoods. They take airplanes into buildings. Cowardly acts, right? Cowardly acts of violence. So I always think that cowards have no NADS, N-A-D-S, name, address, date of birth, and social security numbers. So again, if you think about U.S. Patriot Act, think about anti-terrorism or money laundering. All right, the people that are part of those organizations, they've got no NADS. So you just remember they've got to get their name, address, date of birth, and social security number or tax ID. And those are the 4 pieces of information you need to make sure you are meeting the requirements of the U.S. Patriot Act. The next law is the National Do Not Call List. This one is created so that people don't have to have their lives interrupted when they're having dinner with their children or any other reason. If you don't want to be contacted by a solicitor, you don't have to. Now, for things like collecting of a debt that's due, that's not protected under the under the National Do Not Call List. If somebody is trying to collect on a debt, they don't have to meet the requirements of the Do Not Call List. If somebody is trying to sell you something like a donate or trying to get a donation from a religious organization or a political group, they are not subject to the rules of the National Do Not Call List. But anybody else who's trying to sell you a product or service, they are required to have or to adhere to the National Do Not Call rules. All right. This one is managed by both the FTC because it's financial information, but also FCC because it's communications, so the Federal Communication Commission. They go through, because it's things that are going over phone lines, so that falls under both FTC and FCC. This is all about the management of phone lists or phone calls that can be made to people who have chosen to not get those phone calls or not want them. There are 2 lists that need to be maintained. One is the national list. The national list must be downloaded at least once every 3 months because that list is constantly being updated by new people being added to it or removed from it every day. The internal list must be updated every 30 days. The internal list is your specific company list. It says Charmaine Lane has determined that she does not want, or has told us she does not want any phone calls from ABC Mortgage Company anymore. Even if I'm not on the national list, I can ask ABC Mortgage not to contact me anymore, and they have to adhere to my request. So the national list, however, I can ask ABC Mortgage to not call me anymore, and I can still receive phone calls from anyone and everyone else because I'm not on the national list. If I I put my name and register it on the national do not call list, then pretty much anybody trying to sell me a product or service is going to be in violation. And the fines for this are really steep. You're going to see that in just a moment. So if I receive a phone call, when I've asked to not be called by that company, they have 30 days to remove me from their list, and those calls should stop. Now, you should stop receiving phone calls if you've put your name on the national list. However, the internal lists are what get updated every 30 days. Even though somebody has put their name on the national list, the companies are not required to pull that list for every 3 months. So if you've asked that company individually to stop calling you, they have to stop calling you within 30 days. If you've added your name onto the national list, but they pulled their list in January and you didn't get added until February, you may still receive calls all the way up until March. All right. Fines of $16,000 per incident. You catch somebody in a bad mood who answered the phone and you didn't know, or you missed it somehow on the do not call list and you called them anyway, you could be fined up to $16,000 for one phone call. That's a pretty darn painful consequence. So you better know who is on your list and cross-reference it to make sure that you're not calling anybody that is asked to not be called. All right, now, there is something called the EBR, that is your established business relationship, and the EBR says if somebody has requested information from you, then that pretty much gives you a window of opportunity by the National Do Not Call rules. So if I ask you to give me a quote for a home loan, and you call me back, even though I may or may not get it from you right away, you have 3 months to continue contacting me. Now, better yet, let's say I do go through the loan with you and I've decided to close that transaction. After the close date, I have up to 18 months to continue contacting you. So I'm the customer, you're the loan officer. I am on the do not call list, but I've closed a deal with you. I've closed a financial transaction. Therefore, you have 18 months to continue contacting me to try and sell me another product or service. Okay? But if I've only inquired with you and I did not close the deal, that only allows me 3 months to contact you to try and get you to buy my product or service. All right? Consumers on an internal list cannot be called even if they're on or if they're considered an established business relationship. So example, you call me for 3 weeks, you have 3 months to call me. But one day you just caught me in a bad mood and I'm like, you know what, Char, I'm done talking to you. Stop calling me. Never want to hear from you again. Put me on your do not call list. Now, even though I inquired for information 3 weeks ago, and legally you could contact me for up to 3 months, but that time frame ends the moment I ask you to stop calling me, to put me on your do not call list. So that 3 months goes down to 0 days anytime I've asked to be put on your do not call list. That 3 month time frame from inquiring for information is now obsolete. I've asked to be put on your list. You can no longer call me, even if it falls within that 3 month time frame. All right. The next one is a fairly complicated law. It's called HOPA, the Home Ownership and Equity Protection Act. Now, one thing to know about HOPA is some of the qualifying factors that put a loan into this category, which you don't really see a whole lot anymore. Major lenders and even small, midway members or lenders, they do not like to do these loans anymore because they're just really risky. And if you screw anything up, you're going to get yourself into a lot of trouble. So you don't see a lot of HOPA loans. Now remember, HOPA has 2 other names, but they mean the same thing. There's HOPA, high cost loans, or Section 32 loans. All three names mean the same law. They're talking about HOPA. So really this was about predatory lending, making sure that people aren't being taken advantage of. But the requirements that allow a loan to fall into this category change on pretty much a yearly basis. So if some of the numbers you don't know here or don't match up with exactly what they are today, it's because they change all the time. So make sure that you cross-reference this information for the HOPA thresholds to your state's requirements. You can just do a Google search or whatever for that. Or double check with your pre-licensing education provider and find out what the rules are at that point. So when it comes to HOPA, again, it's known as high-cost loans or Section 32 loans. The law of HOPA originally was created, actually I thought it was in 1990, it was created originally in 1994, it was modified in 2002, and then again, there's always annually adjustments being made to the numbers, kind of like inflation changes, so does the thresholds for HOPA. This law says if you fit into this certain category, you've got additional disclosures and rules that you have to follow. It's enforced by FTC. It's overseen again by the CFPB, but it's enforced by FTC. This allows the feds to prohibit additional practices it finds to be unfair or deceptive. You're also going to hear some things on a regular basis in the mortgage industry about UDAP. It's either UDAP or UDAAP. That stands for unfair, deceptive acts or practices. And then there's unfair, deceptive, and abusive acts or practices, depending on what state you're in. But that's pretty much what HOPA kind of falls under, is that there's unfair or abusive practices that take advantage of consumers. All right. If somebody does find that they were not properly disclosed on a HOPA loan, they can sue for recovery of either just regular damages that can be actually statutory or actual damages. And now, if you do a HOPA loan and do not properly disclose, that's going to give you that 3-year right of rescission that we discussed earlier under TILA. So what makes a loan fall into HOPA? Great question. The total fees and points, if they meet or exceed one of these following thresholds. If the fees you are charging, you the broker lender, that's again the only fees that you are in charge of. So these would be your APR affecting fees like lender fees, broker fees, and escrow fees. If they total more than 5% of the loan amount, then you have a HOPA loan, and that's on a transaction of $20,000 or more. If you have a transaction that is less than $20,000, you are limited to 8% again of the total loan amount to a total of $8,000 or 8%, whichever one is less. Now, I guess it would be whichever one is more because it's either 8% or $1,000. If it's 8% and 8% is more than $1,000, it would be the 8%. All right, so if you have a $100,000 loan and your total fees for lender fees are over, or APR affecting fees are more than $5,000, then you have a HOPA loan and you have to properly disclose. Again, if the loan amount is over $20,000. Another category that would be a threshold you have to pay attention to, let's say you clear this one, then you have to do the second test. If the annual percentage rate is more than the average prime offer rate, that is not the same as the prime rate, it is the average prime offering rate. It's called the APOR, by more than 6.5 percentage points on a first mortgage or 8.5 percentage points on a second mortgage. So again, what does all this mean? Let's say, for example, okay, let's say APOR, again, that is your average prime offering rate. Ultimately, you can just go to Google again and type in APOR or average prime offer rate. And what this is over the last month, what was the average rate interest rate given to borrowers on loans that closed over the last month, okay, or in the last month. That would be the average prime rate that was offered to consumers in that month. So let's say the average prime offer rate was 4%. Okay? You are allowed an APR, an annual percentage rate of up to 6.5% over this. So if you go with that, you're looking at 10.05%. That's a pretty darn high annual percentage rate. So a lot of margin for error there. But if your average prime offer rate was 2, well, that brings that down a fair amount, right? So again, on a first mortgage, if your APR exceeds the APOR by 6.5% on a first or 8.5% on a second, then you have a HOPA loan, and you need to make sure you properly disclose it as well as follow some additional rules. All right. Certain things are prohibited, so these are those additional rules I was just talking about. If you have a HOPA loan that fit those other thresholds or exceeded those thresholds, then you are not allowed to have a balloon payment that calls the note due and payable in less than 5 years. You have to keep the loan on the books and not call it for full payoff in less than 5 years. You cannot have a loan that negatively amortizes. You may have heard of neg-am loans. They used to be like the pay option arms, or the pick-a-pay loans is what they used to call them. Let me give you an example. Here is what a negative amortization loan would do. Again, another fun little example. Let's say that you've got a teaser rate of 1%. That would, back in the day, have been what you were advertising. Okay? This is your neg-am payment. Negative amortized payment. Your real actual interest rate, your true rate, let's say is 4. But you only need to make the payment based on the 1, okay? So this would be your actual, like your 30-year payment, okay? This is your 30-year. You could also have a 15-year payment. So this is your 15-year rate. All right, and let's say it's 3%. Actually, your rate would stay, your payment would stay the same. Your payment is what would change, your rate would stay the same. So this would be your 15-year payment. All right, and then you've got your interest-only payment. Still going to be based on the 4%, but the amount of the payment is what's going to be different. So you're only required by the lender to pay the 1%, but you've got deferred interest, right? Your rate is 4%. You're only required to make a payment on the 1%. So let's say, for example, I'm just going to completely make up these numbers. I'm pulling them out of thin air. Let's say that this payment is $500. The actual interest rate payment is $1,000. It probably wouldn't be that much of a difference, but maybe it would. The 15-year payment is $1,200, and the interest-only payment would be a little less than this. Let's call it $900. All right? You want to buy a house. You want to buy a house that you probably can't afford, but it's nicer and bigger, and you want it. So you're going to opt for the more expensive house with the neg-am payment. You make the payment. Your rate is 4%, which is really a payment of $1,000. You're only required to make the $500 payment. Is the lender going to say, oh, that's okay, forget about that $500 in interest that we haven't received, we're just going to forgive you for it? No, of course they're not going to do that. So what you're going to do is they're going to defer that interest. So you have a $100,000 loan amount. All right, they're going to add that payment, and now you owe $100,500. You're living in the house, and this is what made so many people go upside down. Every month you do this, it's going to go up and up and up. Then it's going to go to $101,500. Every month you choose to make that lower payment, that's going to negatively amortize your loan. Because basically on a regularly fully amortized loan, you make a monthly payment and your principal goes down, right? Well, in this case, it's negative. It's going opposite, which means your principal is going up because you didn't pay the full interest that you should have paid, okay? So now remember, This one is a little bit of a poor example because this has some principal included. Technically, it would be the difference between this payment and this payment, but you get the gist, okay? So that's what the purpose of that example was, understanding what negative amortization means and how it works. All right. Repayment schedule, consolidating more than 2 periodic payments. So again, if you are doing a loan and you fall under HOPA, you cannot require that the customer make more than 2 payments at closing. This used to be an old hard money tactic. Somebody was kind of in a desperate situation, so they would say, all right, I want to make sure we get our first year of premium or payment from you, so you've got to pay 1 year of payments at closing. Can't do that anymore. Ever since the 2002 revision, you have to only, or you're only allowed to collect 2 payments at closing. Everything else has to be monthly. You can't put a borrower into a new loan that has a higher interest rate than the loan they had if they had gone into default or were behind on those payments. Makes sense, right? If you can't pay the payment on the 6%, how are you going to pay the payment on the 8%? Okay? Not just allowing you to refi and get out of your trouble, it's just asking for more trouble later on. Now, a prepayment penalty, which again we talked about earlier, which is 6 months of interest on the remaining principal. You cannot have a prepayment penalty if you pay off the loan early, unless it's limited to the first 2 years, unless it's going to be paid by the lender, the new lender that's refinancing you out of your old loan. If the PITI does not change in the first 4 years. I kind of said that backwards. Prepayment penalties are prohibited unless there's no change in the payment in the first 4 years. And the debt to income ratio does not exceed 50%. If you don't fit into any of these categories, then you cannot have a prepayment penalty. So they're prohibited. You're not allowed to have a prepayment penalty unless the prepayment penalty is limited to the first 2 years, unless the prepayment penalty is being paid by the new lender, if the PITI, the principal, interest, taxes, and insurance, does not change in the first 4 years, and if the debt ratio does not exceed 50%. If you go out of those bounds, you cannot have these are the only way you can have a prepayment penalty in the event you are doing a HOPA loan. All right, prohibited terms, again, due on demand clauses. What that means is in the event a borrower goes into default or makes a late payment, you cannot require that full payment is due. You have to go through your proper state limits or state requirements for filing for a foreclosure. What used to happen is a company would say, if you're late by 5 days, we're going to call default on your loan. Well, you can't do that anymore. You have to have you have to follow the state requirements for following a default procedure. It's not superseded by an individual contract. This is a required disclosure under HOPA. It specifically states this is your rate, this is your payment, this is how much it's costing you, this is why you are considered a high-risk loan, and this gives you an additional 3-day cooling off period. So if you're doing a primary residence, owner-occupied refinance, you're going to get to a point on a HOPA loan where they have to give you the HOPA disclosures. They're letting you know you're paying a lot of points or fees to get this loan. Maybe there's a justified reason. They're refinancing you out of foreclosure. They're refinancing you out of a bankruptcy, something like that. Something that made you higher risk, and nobody else will give you the loan. And that's why they called it hard money, because it was hard money to get. So you're doing this hard money or this HOPA loan, and the lender has to let you know you fit into this special category. And then what happens is they have to give you this disclosure. You must wait 3 business days after you get that disclosure to sign all your final loan documents. And if you are doing an owner-occupied refinance, you have to wait another 3 days for the standard Truth in Lending Act required rescission period. So technically there's about a 6-day rescission, but it has to be done in 2 steps. Sign and receive the cooling off period first, wait 3 days, sign the rest of your loan documents, wait 3 days if it's an owner-occupied refinance. Now, another category of higher risk or considered predatory lending loans is a category called higher priced loans. Higher priced loans is not as severe as high cost loans, But there is certain thresholds that if you exceed them, you're going to have now new requirements. This again applies to closed-end loans, which means loans that have a definitive end date. And I mentioned these numbers a few times before. When the APR, the annual percentage rate, exceeds the average prime offer rate by 1.5% on a first mortgage, 2.5% on a jumbo loan. And people may be going, what the heck is a jumbo loan? That's basically non-conforming, or it's a loan amount over $417,000. That's what jumbo means. And the last one is 3.5% on a second mortgage. So same example, actually is the one beforehand, sorry, I'm not pointing at the right board. When you have an APOR that's 4% and your APR is 5.5%, you've met the threshold for a higher price loan. So you're limited on what you can do now. What that means is, and again, higher price loans applies to these, not these types of loans. The standard loans you're gonna do on a regular day-to-day basis anyway, these rules will apply to. If you're doing a construction loan, a temporary or a bridge loans are usually a 12-month short-term loan. If you're doing a reverse mortgage or a HELOC, these rules do not apply, okay? It's basically just, they don't apply to those loans. But if you are doing a higher price loan on just a regular, regular home loan on a primary residence, single family, they have to verify the ability to repay. The prepayment penalty is generally going to be prohibited to the first 2 years of the loan, but it's completely prohibited no matter how long or how short it was that you're going to ask. Like in this one here, you can have a 6-month prepayment penalty or a 1-month prepayment penalty if the periodic payment of principal, interest, or both of them, or the P&I, can change at any time in the first 4 years. So if you have a 3-year ARM, sorry, you cannot have a prepayment penalty in the event you have a higher price loan. All right, if the source of the prepayment funds is a refinance by the same lender, so you've got a Bank of America loan now, and you are refinancing into another Bank of America loan, just rates are better now, that lender cannot have a prepayment penalty on either the old loan or the new loan if they fall under higher priced loan category. Now, if you have a higher priced loan, you must have an escrow account. Again, escrow means you're collecting for hazard insurance, which is like your homeowner's insurance, or it is your homeowner's insurance. PMI, which is private mortgage insurance, which is what you have if you put down less than 20%, and your property taxes. Those are required if you have a higher price loan. They are required for a first lien securing the borrower's dwelling. So a first mortgage, you have to have an escrow account. Hazard insurance escrow may not be required if the homeowners association covers the master policy. Very, very often, what the lenders are usually worried about when it comes to homeowners insurance is if this house burns to the ground, are we going to be able to rebuild the house again so we have an insurable asset? Well, if they do, or if that house does burn down to the ground, we want to make sure that it can be rebuilt. But in a condo situation, oftentimes the homeowners association, they will cover structure. Sometimes they'll at least cover the exterior structure to the very bare walls, and then everything walls in falls under your own personal insurance. But oftentimes the homeowners association will cover the entire property, the interior, like the flooring, the carpet, the hardwood, the countertops, the sinks, the cabinets. If you're buying a condo, you want to make sure you know what the homeowners association is going to cover. Are they going to rebuild the entire property all the way into the very center, or are they only going to go to the bare walls and you're responsible for everything else? But if it is a master policy that covers the entire structure of the building, you as an individual don't even have to have homeowners insurance. You could just have like a renter's policy that would cover your contents. All right. The property tax escrow may not be required, again, if the homeowners association pays it. Generally, however, if an individual unit can be sold to an individual person, then typically you're going to pay the taxes on that. That was it for HOPA and higher priced loans. Our next category is, or our next main law is Home Mortgage Disclosure Act.